In this video, I'm just going to look at several markets. I'm going to start with oil. We've got a trend line break today. Um, Oil is at just a little under $51. So far, anyway, unless this can recover, this looks like we've got a left translated intermediate cycle. This topped way back at the beginning of the year. This daily cycle has not been able to make a higher high, and now we've got a big move down that has broken the cycle trend line. And that should mean that oil is preparing to move down into its yearly cycle low. You can see that yearly cycle low occurred in early in the year last year. So if you extrapolate forward about 12 months, then we should be due for that again in the spring of this year. I suspect that this left translated cycle here, that there's definitely a possibility that we could retest $40 again in oil. I really don't think we're going to go below it. Maybe marginally we could break it, but I don't think we're going to go back down and test this. This was a 3-year cycle low in the CRB. I don't think we're going to go back down and test that again. But a yearly cycle low should be pretty scary, and I would say that there's a decent shot, especially with this being a left translated cycle. Usually left translated cycles will move below the prior cycle bottom. So if we use this as the prior cycle bottom, just a little above 40, then it would not be unreasonable to expect this yearly cycle low to maybe break this low and maybe go down to test 40 or maybe marginally below it before the yearly cycle bottoms. So that being the case, I think we've got more downside in energy. Just a 38% retracement of this rally still leaves the energy stocks with a lot more downside to go, and I don't think a 50% retracement would be unreasonable, especially if we were to see oil drop back down to test that $40 level. So I think we're going to get a good buying opportunity in energy sometime in the next month or two, but I think it's still a little bit early right now. I think you need to wait a little bit. Moving on to the metal sector. Yes, we are due for a bounce at some point. This could unfold in one of two ways. Either we could bounce like today or tomorrow and then rally into the FOMC meeting and then roll over and move back down, or we could just continue down and put in the daily cycle low, maybe on the FOMC meeting or a day or so on either side of it. I don't have any idea which way it's going to play out, but I can tell you that looking at the weekly charts, we've got a weekly chart of GDX here, that it seems like there's little doubt at this point that this is an intermediate decline. Daily cycle lows they don't take 4 weeks to play out. So we're going to get a bounce at some point, but I think at this point you have to expect that bounce is going to be a dead cat bounce and not make it very far before it rolls over and then we get another leg down. So, I think at this point traders had better plan for the December low getting tested at some point during this intermediate decline. Stocks, I'll say again, I really don't expect that the Fed or the plunge protection team is going to allow stocks to generate very much downside ahead of that FOMC meeting. They want to raise rates, and it would be tough to do that if the market is correcting into that Fed meeting next week. So I think we've got protection here in the stock market for at least another week, and I wouldn't be surprised if they raise rates next week, and then the protection continues, and then we get that that final move of that T1 pattern that I talked about in one of my other videos, and that has a target on the S&P of maybe somewhere between 2440 and 2450. So I wouldn't automatically assume that the stock market is going to top right after the FOMC meeting. I'm going to say there's decent chance that that T1 pattern is going to complete, and we get one more push up just a little bit higher to stretch the market just a little bit further above this long-term moving average. And then I think at that point, then we get some kind of a crash event that retraces, at least back down to this consolidation zone here around 2250 to 2260. And finally, a look at the bonds, because I think this is going to be the trigger to cause problems this year. I've gone over this before. If we get a dislocation in the bond market, I think it's going to cause problems in stocks, and I think it will ultimately be good for gold. But well, let me just go over this. So anyway, we've got a very aggressive move down into a yearly cycle low. The bounce out of a yearly cycle low should be the strongest rally of the year. You can see here, we've got a yearly cycle low, big powerful rally, yearly cycle low, pretty strong rally. But this rally out of this yearly cycle low is not following that pattern. This is forming a very weak bear flag along this 200 week moving average, and that is not how a rally out of a major yearly cycle low usually plays out. This is threatening to become an extremely left translated yearly cycle. And so this could be setting up for that next big move down. And I think that's where the problems are going to occur. So if the next leg down were to play out in a slow, controlled manner, maybe something along these lines, just a slow stair-stepping move down, I think that's probably very good for the stock market, and that might be bad for gold, negative for gold and silver. But I am not convinced that this is going to play out that way. I've never seen a bubble deflate gracefully. I've never heard of a bubble deflating gracefully. They all dislocate usually. So I suspect that what we're going to see is when this bear flag breaks, we're going to see something a lot more extreme. Maybe something more like this, maybe a slight break of that 200-week moving average, and then an attempt to recover it. And then when that fails, I think the bottom could drop out of the bond market. And that's not a signal of rates normalizing. That's a signal that there's something broken in the market. And this scenario, I think, is very detrimental to the stock market, very detrimental to the dollar, and probably good for gold. And here's the reason I think it would be. If this were to play out, it would threaten to take down the housing market. It would probably cause a big move down in the stock market. And I think the Fed would panic, and they would immediately jump in and try and prop the bond market up. And they're already busy trying to prop up the stock market, the energy markets, and if they have to try and prop up the bond market too, then there's not going to be any other choice but to start QE 4 or 5 or whatever number it is, and that I think would be detrimental to the dollar. It would probably stop the crash in bonds, although it wouldn't stop the bear market, and I think it would stop the move down in the stock market, and then the stock market would start to head back up. But I think gold would also start to rise. I think the key is the bond market. If we get a dislocation, something looks like this, then I think it's game on for gold and silver. I think it's the death knell for the dollar. And after maybe a serious correction in the stock market, then I think stocks would turn and we would continue the bubble phase, which I believe is probably in process now.